do I interpret options chain data for call options? Imagine you're looking at a menu of choices for a stock you like. That menu is called an options chain, and it shows all the available call options for that stock. To understand what it all means, you need to know what each part of the chain tells you. First, look at the expiration date. This is the date when the option contract ends. Short-term options might cost less but can be more unpredictable. Longer-term options cost more but give the stock more time to move in your favor. Next, check the strike price. This is the price at which you can buy the stock if you exercise the call. Strike prices are listed from lowest to highest. If the strike price is below the current stock price, the option is called into money. If it's near the current price, it's at the money. If it's above, it's out of the money. Out-of-the-money options tend to be cheaper but riskier because the stock needs to rise above the strike price for you to profit. Now, look at the bid and ask prices. The bid is what buyers are willing to pay, and the ask is what sellers want. The smaller the difference between these two, the easier it is to buy or sell quickly. Volume shows how many contracts have traded today. Higher volume means more activity and easier trading. Open interest is the total number of contracts that are still open and haven't been closed or exercised. High open interest suggests a lively market for that option. Implied volatility is a measure of how much the market expects the stock to move. When implied volatility is high, options tend to cost more because bigger price swings are expected. The Greeks are numbers that tell you how the option's price might change. Delta shows how much the option price will change if the stock moves $1. For call options, delta ranges from 0 to 1. Theta is how much value the option loses each day as time passes. Vega shows how sensitive the option is to changes in implied volatility. When you put all these pieces together, you can decide which call options fit your trading plan. If you think the stock will rise a lot before the expiration date, look for call options with strike prices near the current price, reasonable implied volatility, and good liquidity. Understanding the Greeks helps you see how risky or rewarding an option might be. For example, a high delta means the option's price will move close to the stock's price, while high theta means the option will lose value faster as time goes on. By analyzing all these factors, you can make smarter choices about buying or selling call options based on your expectations and comfort with risk. Remember, the goal is to use this data to find options that match your market outlook and help you reach your trading goals.